I'm joined now by David Watts, Westpac, New Zealand's Chief Risk Officer, who just gave us a talk, and is going to expand a little bit on a couple of points that he brought up during the talk. So,
fantastic,
David.
Yeah, look, a couple of things that we're talking about this afternoon, really around the embedding risk appetite statements in the way that the organisation works, and making sure that one has the appropriate risk culture, but underpinned by the phenomenal change that we're seeing in the regulatory space in terms of the volume, the velocity of change that we're seeing, and going through the full A to Z of regulatory change. So I think when one considers that and determines where is it that a Chief Risk Officer can add value, it comes down to managing that change appropriately, making sure that we take the opportunity to move from a feeling of trying to be too big to fail to getting into the space where we're too good to fail, and our regulators, our legislators will continue to drive us in that direction. One of the main points I try to make to our people and to our board is that the job of the risk management team and of the Chief Risk Officer is to minimise the volatility in our earnings. So it's not about necessarily reducing or avoiding risk taking. In fact, it's about risk taking. We've got to continue to take risks. That's what good banks do. We can't take shortcuts, but in taking the right risks and managing them well, we continue to drive return for our shareholders. We continue to support the economies in which we operate. It's a very, very important part of the economy, and to keep that going is critical for all of us. The minimisation, you can't do that. The only way to avoid losing money in a bank is to stop lending money, to stop taking risks, to stop trading. We're in the business to take risks. So we've got to take smart risks, well-considered risks, risks that sit within our risk appetite, and you've got to have articulated that risk appetite in such a way that people understand what it is that they need to do day to day. And I think that underpins a good culture of risk management in our organisation. And the minimisation and the volatility in earnings actually drives significant value, and we can produce models that demonstrate that that value is quite significant. And yeah, we've been through some very tough times. All of our organisations have been through tough times, and there's potentially some good times ahead still for all of us.
Hopefully. You mentioned something that interests me quite a lot, the CAPM analogy. So, I mean, the message you're trying to drive home there, I'm assuming, is that, again, going back to what you just said, there's a risk-return trade-off, basically. And so do you think that that trade-off was basically out of sync in the years building up to the crisis, where we had this illusion of low risk and these extremely high returns, which should have been an indication maybe that the true volatility was probably higher than what we actually thought it was.
And I think you're absolutely right. The illusion of high returns with low risk is not a sustainable proposition. It never has been throughout history, and we've moved from various crises throughout many decades, and we're between crises to think that this feels normal. It's today's normal. We're going to figure out what the next normal will be and what the next crisis will be. And if you adopt the capital asset pricing model, as I went through, we need to temper those thoughts with one thing, is we're a very, very highly regulated industry, and one of the assumptions that underpins that model is that we have perfect markets. Perfect markets operate when everybody has the same information, and we have a good feeling about how people will behave, and we've seen some irrational behaviour that's led us into some of the most recent crises. But the crisis wasn't unique. We haven't found any blindingly new ways to lose money. We've got to be able to learn from the lessons that history tell us. Our industry becomes way too expensive to learn only from our own mistakes. We can't continue to play that way. We've got to think about what could be as well as what has been, and understand that what has come before us will never ever be considered the worst case scenario. There will be another crisis. We've got to identify it early, and we've got to make sure that the decisions we take every day are appropriately priced. Now, what the CAPM model does for us is give us a price on the capital that we hold, and the regulations that we're seeing are starting to force us into a position of we need capital buffers to remove us one step further from the impacts of the next crisis. But that capital doesn't come without a price. You've got to be able to pay that price, and when you hold that capital, the only way to pay for it is to pass that cost on. And in a competitive environment, that's not going to be easy. but if everybody acts rationally, that will be the natural outcome.
Okay. You also talked about regulatory uncertainty. Could you expand a little bit on that and on what dangers you see there?
Yeah. Well, look, I think what we're observing at the moment is a tsunami of regulatory change, and not just our core regulators, but regulators all around the globe getting involved in changing the rules, trying to dictate what the landscape should be. And when you add all of that up, it becomes quite a significant challenge for financial institutions to say, well, which bits do we need to do first? What order do we attack them in? Which ones of the regulatory change give us some opportunity to differentiate ourselves or grab a first mover advantage? Which of those changes is best to go last, get the last mover advantage and see who does it well or who gets it wrong? And some of it is just your ticket to the game. You've got to do that. You've got to spend those dollars. And for the risk management teams, that's about how do we spend those dollars in a way that's appropriate, minimise the expense to the company and keep our ticket to the game. What's uncertain is the future changes, and even our regulators now saying, well, we're not sure what the unintended circumstances will be. So let's put the rules in place and observe it for a while. Even the people writing the rules don't know what the outcomes will be, and that's where the level of uncertainty comes. So you don't want to charge in first and make a mistake. You don't want to be in last if others have grabbed an advantage, and you don't want to spend way more dollars than everybody else does just to keep playing.
Over-regulation, maybe? You're afraid of that?
I think everyone's
talking to
potentially afraid of over-regulation. We regulate because banks are generally systemically important. Some of them will be global SIFIs, as we know. But there are other industries that are as important to our economies, that have significant global positions. Oil companies, pharmaceutical companies, they're less regulated than banks. What has happened, I think, is that financial institutions have become very, very visible because of one round of failure where a lot of public sector money has been spent to bail out our banks, some of our banks only, I've got to say, to make sure that the impacts on the economy aren't to the extent that we can't withstand that crisis.
Any last thoughts?
I think for when we write the history of what's happened in the last few years, the survivors always get to write the history. So those of us that have come through well governed shouldn't miss this opportunity in the spotlight to say, well, we got through the crisis because we did have good risk culture, we had well articulated risk appetite, we had good governance frameworks, and we had good culture, and let's not forget those lessons.
Great. David, thank you very much.
Thank you.